How's it going, fellow traders? This is Magic Trader here for the September 5th, 2017 CFTC report. Posted the data on the community. Here's a snapshot look of what was gathered. And so let's take a look at gold and see what the institutions are doing here. So what we can see here is over the last 4 weeks, gold longs have become aggressive, right? 4 weeks, so that would be 1, 2, 3, these candles here. So yes, aggressive, heading in and breaking through monthly supply. So big thing has happened. Excuse me. So I also want to show you something here on the charts that I found on gold. So I think this is very important to recognize. We have a 3-month trend line going down here, which has now been broken by this here. Okay. So if we get a push higher up to this area of resistance, I believe this is the weekly supply zone tested right here, and we get a drop down, this will be the perfect location to take longs, right here, straight up to there. So I'll be waiting and watching for that to happen for sure. So for now, we're seeing some really good numbers for longs. We see that they've been increasing for the last 4 weeks. And in terms of shorts, they're holding below average. They increased slightly with this candle here. They increased slightly their shorts, but nothing significant. Pretty much neutral territory, which is what we want to see. All right. Percentage of long exposure 79, and net positions increase from positive 231,000 to a positive 245,000, which is great. These are really good numbers that we'd like to see to support the long bias. So right now, what I'd like is I'm waiting for a nice pullback somewhere. If you look at the daily chart, there's nothing but really badly formed daily demand, so we could get a drop down here very soon to this weekly area, which is nested within this area here. So this would be a good area here to take longs. Plus, this is the last time, this area was the last time 10,000 long positions were filled in by the institution. So definitely be interested in taking gold long down at that area. Oil. What are the institutions doing with oil? So they increased their longs, but back in August they were at 676. Then they decreased it. Right? This is all happening during this consolidation here. Then they decreased it to 663, and then they increased it back to 675. Bottom line is, longs are very aggressive. But here's the thing that gets me. If you take a look at shorts, you'll see over the last 2 weeks, they increased it to a point where it became aggressive. Now, typically when we have longs being aggressive and then all of a sudden shorts become aggressive, it's usually, depending on the context, but it usually means that they're about to hedge. So meaning, you know, if you're adding shorts at these areas here, right, and you're also adding longs. So if you believe price was going to drop down here, but you wanted to fill in 800,000 longs, you wouldn't be waiting for price to drop down here to add the longs, because you know that once you start adding longs, price is going to shoot up. So you want to start accumulating longs, right? But you'd like them to be at this price. So what do? Is you start filling in longs at this price up here, but you also fill in shorts, so that as price drops down here, as you are losing money from those longs that you added, you're also gaining money from the shorts that you added. So it pretty much balances out the total to being around zero or whatever ratio they're using. But for sake of simplicity, let's just say that they balance out to zero. So price drops, they're losing on their longs, but they're gaining on their shorts. Once price gets down here, all they have to do is close out their shorts, and now those long positions start profiting from this area down here. So it's really genius how it works, right? Because they close out their shorts for profits, so they don't lose out on their longs that they opened up, and then they can start profiting from their longs down here. But they got them filled up here. So it's really, really genius. It's a way that the hedge funds fill in large amount of orders without having to fill them at the exact spot that they want to get them filled at. So it's a possibility that that is what's happening, since we do have a weekly supply in control, and yes, it's been tested and eaten. But this is a little bit concerning. So the coloration of the cells are blue, right? They're no longer green. So that tells us that there's a neutral bias in the air right now, and we should probably wait to see what's going to happen. Okay, so yeah, let's take a look. Right here, oil. I have an order to go long here, because regardless of what the CFTC data is suggesting for the last couple weeks, the technicals and my trading plan tells me that I can take a trade right here. Okay, yes, we have this area here of monthly supply, which is really poorly formed and is very, very questionable. It should be still considered an area of supply, but that area is up here. Okay, we haven't touched it yet, and all we've touched is a very poorly formed weekly supply zone. And remember, this supply never even removed a demand zone. All it did was cause the removal of this trend line. Alright, so that's all it did. So the fact that that's very weak, the fact that the institutions are heavily long biased, I've got my order to go long here. Here, stop loss here, and my first target is right here, and then I have targets further up. Alright, so let's get to the next one. US dollar. So what are the institutions doing with the US dollar? So the institutions are still aggressive with their shorts, although you could see that they dropped some off on the last weekly candle right here, the consolidation candle. They closed some of their shorts. Regardless, they closed some of their shorts, but they are still short biased, right? Longs are cooled off, right? You look at the numbers here, they're very much cooled off, and they're also sitting below average for 3 months. Shorts are above average. Coloration of the cells here are red, so very short biased, even though the numbers here are only negative 3.9 thousand. Very short biased. We had a nice drop on the monthly, a pause, and a continuation looks to be in the works right now. So let me see if I jotted down some numbers here for the Dixie. Yeah, plus 6,000. So this last area of weekly supply here, last area of weekly supply, 6,000 short positions were filled in by the institutions. So if we get a push down further, a bounce from here back up here, this area will be a perfect spot to take shorts. Right down like that, and that's what I'll be doing. Okay, so let's take a look at Aussie. Aussie longs remain aggressive, super aggressive, continue to build, which is beautiful, which is exactly what we want to see. Shorts also been increasing the last few weeks, so shorts increasing over the last few weeks right here. So consolidation, shorts. Was that institutions maybe hedging for a potential move to the downside from here? Possibly. But you can see that they were very aggressive with their longs. Exposure still high, 73%, and net positions still high, mid-60s to the positive side. So I believe we get a push right up here. That's what I believe is going to happen. So I'm waiting for new setups to present themselves for me to take longs on Aussie. All right, let's look at the US CAD. What do we see? Shorts increasing over the last 3 weeks, and we have the drop. The last weekly supply, they added 14,000 short positions, so definitely an area where I'd like to get in short. Coloration of the cells are very red, so very strong short bias, and obviously net positions negative 53,000 tells us that the bias is definitely short. So there's no question that the bias here is short. We're hitting an area that isn't demand, so we could get a reaction and then further downside or consolidation here before dropping further down. Swiss, this chart's really ugly. I don't like it. There's nothing to see here. Longs are cooled off, shorts are cooled off, neutral territory. There's really nothing to point out here. And then we have the euro. So longs are obviously aggressive, shorts are cooled off, and that pretty much tells you everything we need to know, right? Long exposure is 66% of their overall portfolio, and net positions increased from last week, positive 86,000 to positive 96,000, so 10,000 to the positive. That's super strong. So are we overextended on the weekly? Yes. Are we overextended on the monthly? Seems like we got a nice pause and easily a push up higher in the works here. So looking for long setups to get in on this one. The pound, this one's a tricky one. So this one's a tricky one because we have a weekly demand zone in control, a tested monthly improperly formed monthly supply zone is in control, but we're pushing up. So then, you know, well, we have longs are aggressive, but we also have shorts being aggressive, and shorts are higher than their average. Longs are just a little bit higher than average. The shorts are higher than average, longs just a little bit higher than average, and short exposure is 66%, but if you look at the coloration of the cells, they're blue, meaning neutral bias, even though net positions are a negative 52,000. So not quite sure why the numbers look like this when we are being so aggressively bullish on the charts. I've been looking for long positions to get in on this, and I'm going to continue to look for long positions, although, you know, penetrating deeper into this monthly supply is going to make me want to wait until price comes back down for me to get in. But, you know, it's a tricky chart. The data is not really supporting it. I want to wait for things to play out so I can learn why this was the way that it is. Alright, so got lots to learn on this chart. US dollar, Japanese yen, here's another one that confuses me, because if you take a look here, longs are aggressive, shorts are cooled off, the bullish bias 72% to the long side, and net positions increasing from 68,000 to the positive to plus 72,000 positions, and we're dropping, you know, and we have room to drop to this monthly area of demand. So are they in anticipation keeping an aggressive long position and then adding shorts until down here, and then they'll go explosively long? I don't know. I mean, this is a big drop. Usually they're not hedging from this high up. So difficult. I'm hesitant to take any trades on this pair simply because this data just doesn't make sense. So just like on the pound, I'll sit back, watch, and learn. The Kiwi. So Kiwi shorts are cooled off. Longs went from aggressive to neutral. Below average size. Shorts around average size. 69% of their overall portfolio is geared to the long side. And a drop for the last few weeks in net positions. Look, we used to be at 34,000. Now we're at 14, 34, 33, 24, 21, 18, 14. So becoming less long is what I see, right? Less long, but that explains the drop. So what I'd like to see now, we have a nice weekly bullish engulfing here. What I'd like to see now is I want to see these longs being built up again, because I do believe we'll come back up, test, and then break to the upside. That's what I think. But right now we're right in the middle of major supply and demand, so it's very difficult to take a trade without putting money unnecessarily at risk. Okay, so that is what I'm watching. That is what I see in the charts for the CFTC data that was recently released. And volatility this week, Swiss National Bank and Bank of England, they're releasing their rates on Thursday, so that'll get things to move this week. Okay, so that's pretty much it for this week, guys. Hope you enjoyed it, and we'll see you next week.